is calculated by, why is this thing off? Okay, sorry guys, I'm just gonna wait here because this thing is not working. This is frustrating. Alright, I think we're back. Are we back? Yes. Alright, okay. It seems that I've lost all viewers in the process. It's okay. I'll carry on. So what we're doing with the stochastic is basically we're measuring momentum, right? I don't know how much of this was lost to lag or whatever it's called, but we're going to try again. So basically we're measuring momentum. We're plotting a line that tracks today's closing price versus the high-low range of the, a preset or look back period, a preset period of days. And we're trying to see where today's closing price is relative to that, okay? In order to do that, what we do is we work out two things: percentage K, percentage D. Percentage K, we look at the current, is basically this equation over here. All right, we look at the current close minus the lowest low divided by the highest high minus the lowest low times 100, and that gives us percentage K. Then percentage D, we need a signal line or a trigger line or whatever you want to call it, so we add percentage D, which is basically a 3-day simple moving average on K. That is a fast stochastic. Then there is something called a slow stochastic, which basically takes, just adds another 3-day SMA on that. So basically the 3-day smoothing that we add to percentage K gives us percentage D. Then we take that percentage D and we add another 3-day SMA on that, and we call that percentage D, and the previous one now the new percentage K, so we now have a slow stochastic. So we just have this effective additional smoothing. A full stochastic is basically a stochastic that allows you to edit all these various things. So let's look at a SSD. Stochastic, not a stochastic RSI, that's for another day. Go away around. Percentage K, we're going to make it green, we're going to make it nice and thick. Percentage D, we're going to make it red. Inputs 1413, that is a fast stochastic because we're not smoothing K, so we are working out K with a 14-day look back period, and we're smoothing that by 3 days, and this is the moving this is the indicator that it gives us. If we then apply a 3-day smoothing on the K, like percentage K, we then end up with a slow stochastic, and we get a much sexier picture. And again, I'm doing this center screen, I'm going to just add it again. 1413 gives us a normal stochastic, so no smoothing of the K line, and we end up with a relatively noisy indicator. If we then add 3-day smoothing on the smoothing, then we end up with a much better looking picture, right? So basically we're smoothing out the, we're smoothing out basically. So what was the percentage D line now becomes a percentage K line, and we're adding a new percentage D line, and that gives us a much better sort of indication, a much easier to read indication that's not as messy as the previous one. So what we do here is we again look at overbought, oversold positions. We again look at support and resistance around the midpoint, around the 50 level. Wait, always does that. And we again look for these overbought, oversold triggers, this time from the 20 and 80 levels. So a moved, a moving average or a percentage D crossover of the percentage K line will be a sell signal, plus a move down through 80 will be a sell signal, and that could be, for example, a nice entry trigger here combined with a break of this range. Hey, that one actually worked like a bomb. Plus then we have the reversal or the buy signal there, and that closes you out at the bottom of this little trend. So hey, stochastic is a bit more accurate than the RSI, it seems. again, you know, we spoke about how these things are stock specific, so it's not always the same. So there are three types of signals, as you can say, with nice trading meme. I did also push, we need to start trading memes, guys, because nobody else does trading memes. Yeah, sorry guys, I see in the Discord you're asking, the stream did drop for a while, I don't know what the story is. It seems to be up and running fine now, so, alright. In any case, so there are three different types of things: overbought, oversold, obviously divergence, and then the trigger lines as well. Sure, alright, so we are almost there. Then we looked at on-balance volume, right? On-balance volume is basically a cumulative indicator that takes volume of today, and if the day is up, it adds it to the previous day. If the day is down, it subtracts it from the previous day, right? So this is a very nice indicator for us to see what is happening. Oy, oy, oy. So in a situation where you can see price is going up here, right? This is actually a beautiful example. We've got price, she is going up. We got a beautiful uptrend, right? But at the same time, we have OBV coming down. Okay, so what this is telling us here is that while we have the trend going higher, volume is decreasing. So that's unsustainable, right? Then in this situation, we have sort of prices moving up and volumes increasing with trend, which is great. Yeah, no coffee. Maybe we need to look at it as coffee. I want coffee. I'll have some coffee in a moment, but not quite yet. Okay, so this is a nice way for us to then look at confirmation. Now remember, to link this back to what we started with, we looked at trends, right? And we looked at Dow theory and all that stuff. And we looked at why we want to trade only with the trend, because it gives us the highest probability of success. This is an indicator that confirms that you know, volume is confirming the trend. So when we see volume rising while price is rising, we know that every day there are, you know, on the up days, more volume is trading than on the down days. And conversely, if volume is falling while the price is going up, that means on the down days, there is bigger volume trading than on the up days. So that shows that there's selling pressure coming into the market, which is, you know, cause for concern. Where are we? All right, so I'm going to go back to my notes here. So it's a cumulative indicator. It adds volume in the up days, subtracts in the positive days. Yeah, I mean, all the stuff I just said, I don't think it's a fairly simple indicator, to tell you the truth. Then, average true range. So basically this works out an average over a look back period again, or over a period of days, what the average range for a stock is. So this is a nice indicator of volatility, right? So there are three ways of working it out: the current high less the current low, easy peasy. The current high less the previous low, or the previous close, or the current low less the previous close. So what you're trying to do is obviously get a positive number. You can't get negative numbers because it's not going to help. So you have to have absolute values to be able to work this stuff out. I'm just checking around for questions. It seems there are none. Except chatting US markets, that's fine. Okay. So yeah, pretty easy stuff really. What you're trying to do is you're trying to find essentially the furthest point away from the high or low of the day. So if we look at today, the high point is this. What is the furthest point away from closing price, however, from today's high or low? That is the, you know, what's the biggest number? And there was a whole table where you have to work out all three, and then you pick the biggest one, and that you then use to add into your, which you're basically making an SMA or a simple moving average on these numbers that you generate by just trying to figure out, when you're looking at where is the furthest distance from today's high or low, what is the previous close, you know, where's the furthest distance away from that. So the actual calculation is then, okay, again, this works like all the stuff That is your first point. Then you look at prior ATR times 13 plus current total range divided by 14, and that gives you this nice little smoothing effect. And then you have it gives you an ATR, right? Average true range. So what you can use ATR for, going back to our fancy Sunlam chart here, thanks to Christy, we are going to look at no man. Sound like a real South African because I am one. Average true range. We're going to make it easy to see. Alright, and basically what this shows us is that what the volatility in the stock we can expect. So we can expect on any given day that this stock on average is going to move around R2.15 from high to low. And that gives us an understanding of what the volatility in the stock is like, and that helps us manage risk better, because if we put a stop loss and we're trading on a daily time frame, when you put a stop loss less than R2.15 away, we know probabilistically this thing has a very high chance of stopping us out, right? So this helps us manage risk. Then we look at different types of divergence. So this is also something that we put the little screeny thing up in the Discord channel. So if you haven't joined and you're watching this video and it's like 10 years down the line, which I hope is what the case is going to be, then join the Discord. It's going to be in there. You might have to ask because it might be buried under tons and tons of new stuff, but it'll be there. If it's not, just ask someone and they'll give it to you, aka I'll give it to you. Right, so we are looking for basically differences between the price movement and the oscillator movement, whether that oscillator is a RSI, a stochastic, or a MACD. It does not matter. Obviously, unbalanced volume and ATR are not going to work in this case, but one of the momentum-based oscillators are going to work. So that is where this comes into play. So there are 4 different types of divergence: normal divergence, both bullish and bearish, and reverse and or hidden divergence, both bullish or bearish. I'll go through all of them very quickly. Normal bullish divergence is when the price is making lower lows, but the oscillator or the momentum indicator is making higher lows, right? Normal bearish divergence is when price is making higher highs, but your momentum-based indicator is making lower highs. Reverse bullish divergence is when you have price making higher highs, making higher lows, while your momentum-based oscillator is making lower lows. So this, in this case, is a trend continuation signal. Sorry, I should mention that the 2 previous ones that worked through, aka the top 2 over here, are trend reversal indicators, not signals, right? Then reverse bearish divergence is when price is making lower highs, but your momentum indicator is making higher highs. So this is once again a trend continuation signal, right? Then we looked at some risk management stuff way early in the first stuff, the 2% rule. I'm not going to go through this stuff in detail because I actually do want to get to some other stuff. But basically the premise here is never risk more than 2% of your money. You work out the distance between your entry and your stop. You see how much risk you take. You then work out what 2% of your portfolio value is. You divide that by the amount of risk, and bang, it spits out the number of shares you're supposed to buy. Cons are that you can gear too big, because sometimes you use 10% margin, or if it's forex, like 1% margin or whatever it is, and you end up with like 20-30 different positions, and you have way more exposure than you have money. And then one move, one highly correlated move amongst all your positions wipes you out, and that is obviously a problem. So the pros are it's very easy, right? There is then the sort of exposure rule, where you say that you can't use more than a certain amount of gearing. So every position is a set size in terms of exposure, and you can't use more than a certain amount of gearing depending on where the market is in relation to its all-time high. So if the market is within 5% of the all-time high, you use 1% gearing. If the deeper the market comes down, the more you can gear. Theoretically, this allows you to add into positions. So the whole premise here is that you can basically gear it up to a maximum of 5 times, and you're allowed to gear to a maximum of 1 time per stock. So you can be long 5 stocks in a 50% crash, be geared be long 100% each. So if you have 100,000 rand, you can have 100,000 rand exposure in each one of these stocks, and you can still be in even if the markets fall, crashed 50%, and then from there, if the market rallies up, you'll make obviously a ton of money. The con is that if you do eventually stop out on one of these things, you take a 12.5% loss on capital per position, which is a very, very tasty loss. This is better for a longer term trading strategy, perhaps. I don't know. There are times where this you might want to use this thing, but it is interesting to give it to you graphically. Here's a little chart that I did many moons ago. So while this market is trading within 1% of its, within 5% of its all-time high, your gearing is just 1 time, so you're not risking more than you're not taking long positions with more money than you have. When the market starts falling a bit further, hopefully you're not in still from the high. You should have stopped out, but now you can start gearing twice when you take long positions. When the market falls even further, you can start gearing 3 times when you start taking long positions, because you have that probability that the market is going to rally a lot harder on your side. So to give you those steps, between 10 and 15%, between 10 and 20%, you can gear 3 times. Between 20 and 35, you can gear 4 times. Between 35 and 50, you can gear 5 times. Then we get to some of the more risk management-y, some more risk management stuff. Basically, we are looking for trends, okay, and we're looking for points into which we can enter into those trends. We want to trade with the trend. The premise of all the stuff that we've covered now basically builds up to a trend following type of strategy. Forgive me, I need to click my neck. I know that it's gross, but I have to do it. So what we do is step 1, identify what the trend is, and then we want to identify entry points into that trend by basically looking at a number of different things, right? So we can say that every time that we come down and test the trend line, these consolidations around this trend line support could potentially be entry levels, or a break of the secondary trend, for example, and a resumption of the primary trend could be an entry point. And we can also look for support and resistance levels that we can use as entry points into these trends, and then we want to use previous lows in that trend, or either the immediate previous low or the first or second previous low in that trend, to use as potential points for stop losses. What we're basically looking for is we're looking for a point at which the market's going to go, where it is unlikely that it'll push that far, and that if it does push that far against us, we can know with absolute certainty that we are wrong and that the trend is potentially changing. So using Dow theory, you need higher highs and higher lows to confirm an uptrend. So if you make a new low, then you are in a trend reversal situation, particularly if you're looking in your primary trend. Secondary trends, tertiary trends, these things can change all the time, so it's good that we take the big picture first, look at the primary trend, determine where the primary trend immediate first and second previous low is, so that if those points are taken out, we can say that we have a primary trend change, and then we no longer look for longs, we now look for shorts, or whatever the case is, right? We also then looked at the building blocks of a trading strategy. Oh man, I'm talking. So the building blocks of a trading strategy that has a risk management element to it. It has an edge identification method, element to it. It also has details about how your edge is. Remember, we said an edge is basically, it's not my definition, it is the definition of an edge. I can't remember where I read it. I think it was in Trading in the Zone by Mark Douglas. Great book, must read it. It says that an edge is nothing more than basically a set of variables that determines that the probability of one thing happening over another is higher. So an edge is basically just a set of rules that we make, that we try to use to put the probability of success in our favor. When those variables are in place, we have an edge in the market, and as long as we only trade on those edges, we should be successful. So, all right, cool. That, if you've missed the last 10 hours, you got it in 49 minutes. I don't know. Now I'm pulling faces and I don't even know if I'm live on the interwebs or not. It seems that it's having trouble, so I'm just going to sit here for a little while. Look at my cell phone. Stream resume. Health is good. Okay. Haha. That thing is green. That thing is green. All the things are green. We can carry on. So, alright, so building a trading strategy. So the things that we have basically gone through up to this point are tools that we can use in order to build a trend following strategy. And if you are viewing this and you are a watcher or a viewer of this stream, I want you to do some homework. I want you to go out and build your own strategy and send it and share it with us on the Discord channel, or send it to me so that we can look at it and I'll talk to you about it. I want you to try and take the various tools that we have discussed here and combine them to create a set of variables that you think puts the probability of success in your favor in order for you to trade, any instrument. It doesn't matter. Remember, this is purely a technical based strategy that we want to develop here. So what do you need to build a trend? Okay, I'm going to zoom in here because some of this stuff is relatively important. Okay, cool. So step one, okay, we need to identify the trend. So we have to find out what is the prevailing trend. Okay, so here we look at the Dow theory stuff. Primary, secondary, tertiary trend. Okay, we want to identify those. Which time frame or which phase is the trend currently in? Right? If we're looking at a daily chart, if we're looking at a 1 hour chart, if we're looking at a 15-minute chart, how do we determine what the trend is on each one of those time frames? And also in what phase do each one of those time frames fall? Because sometimes the daily trend is up, but the hourly trend is down, but the 15-minute trend is up, right? And that could be the three different phases of a trend, just represented by different time frames, correct? Also, you want to maybe make sure that you have all three of those time frames pointing in the same direction, all trending up before you take a long. That might not be important to you, right? So what you want to understand is where is the trend, what is the trend, and where are you in relation to the trend? AKA, where is the price right now in relation to the overall trend? In which direction is price moving this moment or this day in relation to the primary, secondary, and tertiary trend, or working from the small out, tertiary, secondary, primary, all right? You also want to, so this is your Dow theory stuff that you're going to look at. Also, once you have your trend in place, does volume confirm that trend? Because remember, Dow theory says to us that one of the most important things is that volume confirms the trend. So we can use our on-balance volume indicator to tell us whether or not price is, a volume is confirming the price trend. Okay? Step one, look at the roadmap. Where are you? Okay? Where is the trend, and where is price trending, and is volume, very importantly, is volume confirming that trend move? We saw this example earlier on a sand lamb. I'm just going to go back here. We saw this confirmation. This is actually like the best possible example. If you have any other charts, send them. I would like to look at them. So we see this best possible sort of situation here where you have a rising trend, and you have in that rising trend a falling unbalanced volume, and basically what that tells us is that on the days that price trades lower, volumes are bigger than on the days that price trades up. Okay, so this is these are the things that you want to know. You can't be taking longs here in this area if you have this situation. It's just not it's not conducive, right? Our idea is to trade with the trend. So step one, identify the trend. Step two, check whether or not, well, still part of step one. Check whether or not that volume correlates or confirms the trend. Okay? Questions? It seems like none. There's also a delay, so if there are, I'll probably get them later. Step two. We want to know where is the lowest risk place to put our stop loss. Okay? So here you have to use average true range, potentially. You have to use your risk management stuff. You have to use your trend stuff that you say at the previous low, at 2 previous lows ago. You have to look at average true range. If I put my stop at the previous low, at the immediate previous low, but ATR is bigger than the distance from that stop, does that make sense to me? Is that something that I want to do? Is one ATR enough? For example, I use a ATR times 2 trailing stop loss. So I look at what my entry price is, I look at ATR reading, I multiply that by 2, and I use that as a trail to, particularly on like daily charts and that kind of stuff, right? That tends to work pretty well. That gets very complicated. I'll get into that at another time. I have made reference to the fact that that's in one of the, what do you call them? Power hour JSE things that I did. So yes, you want to look at that. You also want to look at moving averages. So do your moving average crossovers, because if you remember, we looked at moving average crossovers, different ways you could trade them. There was the 721 crossover, there was the 50-100 under 200 crossover, there's a 20-50 crossover. Whatever it is that you what you like to use to give you potential signals to buy or sell, are you going to look at these? I don't know if the stream health is good here because it looks blurry on that screen, but I don't know. How are moving averages going to help you manage risk? Right? Moving averages are also nice trend indicators. Could you use a moving average, for example, as a trailing stop loss? That's maybe another idea. If you do, you know, how big of a risk do you take? Do you take a gearing approach? Do you take a 2% approach? What is the best way of doing that? You have the tools, you can sit and you can work it out, right? So these are the inputs that we're wanting to use. The next thing you want to do is step 3. We need a reason to enter into this trade. So, is there a support and resistance level that we're reversing off of? Is the momentum, you know, bullish or bearish at this point? Is there divergence? I should have actually put, is there momentum slash divergence? Divergence, right? Is divergence bullish or bearish? Is it even present? Is that something that is even important to you, right? Does volume support your thesis? Of course, okay. So if you're looking for a bullish entry into a long thing, it would be nice to see some bullish continuation, you know, divergence. So you're looking for reverse bullish divergence, or you might be looking to trade back into the primary trend while the secondary trend is changing. So you'd like to see support come into play, as well as normal bullish divergence, as well as maybe like a break of a resistance level. That could be a combination of things to get you into a trade, right? So to give you an example of that, let's say for example you want to take, I mean, it's always easier with historic data. Somebody give me a stock. Somebody give me a stock. Otherwise I'm just going to pick one. Let's play stock roulette. Eagle eye. I don't know what that is. It doesn't change. Okay. Why first round? No. Alright, PPH. I don't think this thing's even been listed long enough. But okay, cool. So, wow. It hasn't been listed long enough to really even know what the trend is. But okay, let's see. We want to take a trade on this thing. So, what is the trend? Well, the trend is down. Let's call the trend sideways. We have a resistance level here very clearly that we can see very quickly. So we have resistance. Viva la resistance. We have support. Keep in mind these are zones, not particularly, not always like 100% accurate spot levels. So we have a potential range trade here, right? So we have consolidation, break of that consolidation, bit of a back test. This looks like we could have a move down to the bottom of this. So what do we want? Let's look for some. Let's look for some divergence, if there is any. Windows 10 is installing updates. Great. I don't care. Let's remove the background. Let's make it circle bigger. And we make it big, yes, and we want 1433 because we want to smooth it out. So we have a sell signal. We did have a test of this overbought level. It didn't quite make it. We did get a bearish crossover and we have a move down. It would be interesting to see whether or not we break through this 50, because we see that if it finds support at the 50, I am doing it again. Oh my god. If we see, so we're basically looking for momentum here, right? So for me, it looks like we have here, those were higher highs. All right, let's draw them in. Let's draw them in. Where's my line? Those are higher highs and those were lower highs. Let's have a look at what our momentum charty McGarty says to us. Higher highs and lower highs is normal bearish divergence. Okay, and that does seem to have started a bit of a move towards the downside. Now we have lower highs and once again lower highs on our thingy. So we're going to move that there, we're going to move that there, and we're going to look at our thing. Does this tell us anything? No, it doesn't, but we at least have had sort of a bearish resistance or a bearish divergence signal to put in. Okay, so this is something that we can say that momentum has gone from positive to negative and is down, plus we can see that it's in a range, plus we see that this consolidation broke, it retested, came back to the middle of that consolidation, which technically hasn't stopped you out. So you could potentially consider taking a short here with the stop just above the range. I really need to get buttons so that I so okay, I'll go through that again. We have our divergence setup. We see that momentum has changed from positive to negative thanks to the divergence. We have a little range here that it broke out, came back, retested it almost to the middle of that range, didn't actually stop you out because we would put our stop loss smack in the middle of the range, and if you look there, it can even go a bit higher. It didn't actually stop you out. So, and we're about to break to the bottom of the range again, so hey, this looks like it could be a decent short. So yeah, all right, kind of suits the rules, right? This is the type of thinking that I think is important, that goes into building a thing, right? So does trade action confirm? Oh, right, is there divergence? Oh, does volume support our thesis? Okay, let's look at OBV. I did put the divergence thing on, that's crazy. Let's make it easy to see. And let's just show you the chart. So, okay, there's a huge volume spike here, we can see, so it kind of distorts it, so let's look slightly closer. What we have is kind of sideways action, and we have price starting to tick lower here, and we can see that this has actually been coming down over the last couple of days. So on the days that it traded lower, or that the close was lower, we actually had bigger volume. So it seems as though we might have a situation where, as trade price is gently coming down, we have a little bit of a gentle decline on our OBV here as well. So yeah, okay, maybe OBV does agree. Also, another question you have to ask yourself is this many inputs even worth your while, right? Right, then candlestick formations or bar charts or whatever, chart construction stuff. So what we're looking for is some candle patterns where we have I'm just going to delete these things because they're getting in the way. We're looking for some bearish, candle formations or chart formations. Offhand, I can't see anything except maybe 3 or 4 red candles in a row. but offhand I can't see any like overtly bearish stuff. Maybe if we look at a weekly chart, we'll catch a luck. Okay, not yet. The week is yet far to go, but if we do end below this candle, we could have a bearish engulfing on a weekly chart. That would be bad. That would be bad. You know, is it an absolute must that we must have this, or is it a want, like a wish list type thing that we wanted? All right, then we're looking for reasons to exit out of a trade. So you're looking for support, significant support or resistance. You're looking for chart construction stuff. You're looking for you know, a divergence that tells you that the trend that you're trying to trade with has changed. Any kind of warning signs are coming up as well. So warning signs, okay, warning signs and reasons to exit is different. So you want a target price, you want a reason to get out, and that is usually the next significant support resistance level is generally a nice place to come out. Or if you have price action stuff telling you to get out, like candle formations or whatever, if it makes a huge hammer, for example, that is definitely a signal to cover your short. Or it makes a shooting star and you're long, you know, that is price action that's kind of trumping the trends and that kind of stuff. Alternatively, support and resistance levels, and you can use your Gann 2-day method, or you can use your DeMark or Williams method, or you can identify proper sort of support and resistance levels. Let me show you. And then, so here, for example, this is an absolutely confirmed support level, and you can use that as a price target. Alternatively, if you see, you know, that you get a support level forming before you reach your price target, then maybe that's a reason to get out of the trade as well. But remember that here you are trading a primary trend that is actually down, guys, because it started there and it is here now. So the primary trend is down. The secondary trend was up. The secondary trend now seems to be changing down, and the tertiary trend was up here, and we've got now a new tertiary trend down inside the secondary trend inside the primary trend. So I mean, there's no reason actually to be bullish this stock at this point, based on just the stuff that we know about trend following, right? So don't let support and resistance in tertiary trends take you out of the primary trend. It's kind of my point. So look for support and resistance on the primary trend rather than on the tertiary trend to get you out. Then obviously warning signs include you know, all the stuff that we've covered, like anything of these tools that you have in your tool set that shows you the opposite of what you're trading for. And you've got to be sort of flexible and open-minded here to say, like, look, you know, I am long this thing, but these things are giving me short signals, and therefore, or giving me signals that momentum is running out, and this thing might turn bearish. These are things that could get you out of trades, you know, as potential warning signals. So what you want to try and do is end up with a document where you have something. Hey man, I don't know why this Microsoft Word has been doing this to me all day. Let's try this one. Okay, so you have a situation where you end up with something like this, okay? How do I zoom in? Goodness. All right. You basically write down all your different things. Okay, so you give it a name. We call it the fancy poodle trading strategy, and you have certain rules. So you trade with the weekly trend only. Okay, or you know, you've got to make up your own rules here, and this is why I want you to do the homework and send me the stuff, because one, it'll be very interesting, and two, I can help you, you know, understand it. For example, or flesh it out. You know, for example, this is very summarized, but there are, you know, very solid rules below this, which some of the stuff we've obviously gone through, and you have to go do this exercise yourself. Nobody can give you a set of rules and say this is going to make you $1 million, because it just doesn't work like that. You have to come up with your own rules. Only when you make your own rules will you have the discipline to stick to them. So okay, trade with the weekly trend only. Stop loss below the weekly low. 2% risk on capital per position. Allow for 3 to 5 entries per position. So I'm taking less than 2% risk per trade. So, you know, interesting things to consider. Risk reward must be greater than 1 to 1.5. Trade within the macro trend, the universe stocks only. Whatever your base rules are for your trades, okay? So these are your things that you absolutely cannot break. Then you need to have a set of criteria for you to get into the trades. What are your entry signals? You want a reversal of a support level with bullish divergence and a bullish crossover of a moving average, or, you know, whatever your type of criteria is that you think will give you a very high likelihood that you are correct. That is then what your entry criteria is. The same with your exit criteria. So you have to write down, what are my rules? What are my entry criteria? What are my exit criteria? What are my stop loss criteria? Write the stuff down on a piece of paper, stick it to your desk, stick it to your forehead, stick it to your wall. Make sure that you know it, make sure that you can see it all the time so that you can enforce it on yourself, right? I like to add a couple of things, must-haves. So if I do not have a multiple time frame trend, or I do not have a high probability setup, or I haven't set a price target, whatever the case is, for this particular strategy, I cannot take a trade on that strategy. Then there are nice to have things, you know, nice divergence, this, that, whatever, some Fibonacci stuff. So you've got to determine what is, you know, dig in the tool set that you have using all the various tools that we've now sort of gone through, and figure out what is very important for you and what is not very important for you. So for example, volume confirming the trend, must have. Reverse bullish divergence, nice to have. Significant support level that has held and is trading higher, for example. That could be, well, depends on the situation, so let's call that a nice to have. You know, whatever the case is, there are certain things that for you might be more or less important. So determine what those are, determine what your must-haves are, determine what your nice-to-haves are. Then you need to also have, like you have a list of nice-to-haves, you've got to have a list of things to watch out for. So a list of things that might take you out of the trade, and then a list of things that could get you to take the, you know, maybe stop out a bit earlier, or take profit a bit earlier, or close the trade before one of your exit criteria or your stop loss criteria hit. That's basically what the watch out for list is. And that's basically it. I don't know if you guys have questions. I am once again open for questions. Any? No? Okay. Right, so we're going to move on to the trade logger. So what you then have to do is you have to log all your trades. And I want to say thank you to Igor, who is one of the clients, one of my clients. I really appreciate it. He did some work on the trade logger I've made available the first time around on YouTube. He was like, wait a minute, I got things to add. He gooid them in, and he's come up with a much better solution. I was then working on some stuff today. There is still one or two things that I need to work on, but you know, I'll put it available, and then, I mean, this thing is going to be updated all the time anyway. I just can keep improving on it. But in any case, the basic idea here is this is going to be available for you to download, so please feel free to use it. Please feel free to share it in the Discord, and then, you know, share it with me if you want, and then we can go through it, and I can, you know, if you use this trade logger, I'll help you go through trades. We can set aside some time. Obviously, you'll just have to arrange with me, and we'll go through your logger, and we'll look at the charts, and we're like, what went right, what went wrong, what was your strategy, and then you see if you can stick to it. So basically, all your charts, all your trades that you log here to show you an example of how it works. There are a couple of things here. So these you can edit, but you really shouldn't. So these are your brokerage rates. I've got two different account types. So there's a pro trader account, or there's a high frequency account, and then depending on the depending on which account it has, is whatever the fee structure that is applicable. So let's say, for example, we traded Sunlum, because that is, no, PPH was our trade, hey? Yeah. So we take PPH, and we're going to take it on the 7th of March to 2019, we are gonna go short. So we take a nice little drop down and we pick short. I don't know if you guys can read this. I hope you can. Let me zoom in. Bloom, bloom, bloom. Bloom, bloom. All right, all right. Okay, so then we are going to try and get in at, let's say, today's closing price, so 1973. We brought you an album, I don't know if that's a song, and we are going to take, say, 2,500 shares. What we are going to do is immediately, okay, so these are still going to be blank, right? And then this is going to be where my stop loss is going to be. So according to our little thing, let's look at our screen. We're going to stop there. Second previous low. Okay, so let's go just above that, 22.40. Wow, that is a long way away. 22.40. So we are risking 13%. Well, compared to where it is now. If we end up taking, let's say we take at 15.62, then it is going to work out. Yeah, so we're risking 13% of our exposure. So that's quite a bit of risk. Okay? So we need to make quite a lot of reward for this trade. So this might not necessarily be the best trade, but whatever. All right. So we log it. So let's say we take this trade. It shows us here we take 50,000 Rand exposure on 2,500 shares, and we say get out at the bottom. Oi, I'm doing this whole thing. Bang. Right, so we enter into our short position here. We put in the stock, the date, short position, entry price. It works out our exposure for us. The number of, because we put in the number of shares that we want to trade. Then if we cover this trade at 15.62, for example, and we buy all 2,500 back, and we say yes, the trade is closed, you can see here that it calculates our brokerage for us. If we close the trade on the same day, the brokerage is really low. If we close the trade on a different day, let's say we close this trade on the 3rd of June 2019, then the brokerage is a bit different. I just want to see here, 7 March 2019. Bang, yeah, so the brokerage will be minimum. So what this does is this, you have to remember, well, I just want to say that this is built for the cost base that the guys trade through with me, right? So there are two different types of accounts, and I want to show you this. So there is the low frequency trading account. So if you take this 50 grand position, in and out, short, you're going to probably earn around $10 in interest. So this SAFI rate, it's based on the SAFI rate. It will change all the time. I haven't built it in that you can automatically change it just yet, but for now, I don't think interest rates are going to change anytime soon, so it should be fine. But you can see here, so most people are going to be on this fee structure, which is 20 basis points, and then you can see here, there's your brokerage that you're going to be paying. And it sort of works out a whole bunch of cool metrics for you. You put your stop loss in, it shows you this percentage risk is how much risk you are taking on the capital that you have, and then the profit that you're making based on the divided by the risk. So that's quite a cool little metric to show you what it is going to do. So if you basically take here, oh no, that's not 19. We got to take that to 15, buddy. Bow. There you go. So that's the trade we're looking for. I'll just show you. That's the trade from this closing price. Selling 2,500 shares and covering at the bottom of this range is obviously this anticipated trade. I mean, it hasn't happened yet, but that would be a realistic sort of picture of what the story is. You make about 10 grand, so you make 1.5 times the amount of risk you took, because you take 6.5 grand risk, which is 13% of your total exposure, which is actually like really high. So this percentage risk is too high. You can see here that it should be sort of 2, 3, 1, 1.5, 2, whatever. We'll get to that. It's not as important. Well, it is very important actually. It's a very important metric to track. And then the profit risk ratio here is 1.5, which is decent. You kind of want that. Now you have to actually allow the trade. If you then stop out, let's say you put a tighter stop loss and you stop out at all, you know, at 18, then it'll show you that you've taken a, oh no, sorry, not 18, 20. You have to put log that you've taken a loss, what percentage that loss is of your capital that you, or your exposure that you took, right? Your open exposure will obviously be 0. Sorry, this thing needs to go down. Open exposure will be 0. Where your stop loss is, the amount of risk, the margin that you're utilizing. If the trade is still open, I'll just do that. You'll see that your margin rate is in that 10% margin or whatever. On the lower cost accounts, it is 20% margin. So in any case, so this is a nice little place for you to log all your trades, right? It's very simple. It's how it works. Let's just see. All right. And then basically what this does is, what Igor's done here is he's done two really cool charts. So what he's doing here is he's measuring percentage risk. Or percentage R, right? So what he's doing is he's looking at the amount of risk that you take versus the payoff that you get. So your risk-reward ratio. So here, this R is reward, right? It stands for reward. So you can see here on one trade, you got 13.6 times reward on. I just realized something. I might have to delete this video, guys. Goodness, I'm gonna put it offline after this, actually. In any case, so you get 13.6 times the risk that you took on the exposure, right? So that's really great. You can see here, you can track then the amount of risk you take. So if you have these ideas where this is the losses that you take as a percentage of the exposure that you take. So you want to keep this sort of below 1% or below 2% or whatever your risk management rule is, and you want to keep your wins sort of, you know, obviously as high as possible. And there'll be one or two guys that shoot out, and a couple that don't. And then EC basically tracks your this profit risk ratio. And you can see here that one is obviously pushes the whole sort of measurement up, but what this does is it kind of shows you that this is your risk reward ratio, and you want to keep this level to trending up in order to stay on track. When this starts trending down, it means that you're starting to lose money. What this does is it smooths out that, like, you know, as the account grows, your risk reward or profit and loss per individual trade might grow, but as your account then starts to you know, so it might distort your P&L. So these swings, these histograms will get bigger and bigger and bigger, as where if you measure the risk reward ratio and you see that the amount of reward you get versus risk is consistently the same or getting better, then you have a growing account without looking at like the numbers. You're just looking at like the percentage terms. And that, ladies and gentlemen, is that. I don't know if you have any questions. Sorry about the interruptions. I know we dropped a few times, but we are up and running. I will make this stuff available for you to download. And I hope that you found some value in the kind of like building blocks of your strategy stuff. That stuff is relatively important. As a bit of homework, please please go ahead and build your own little strats, share them on the group, let's chat about them. You don't have to share them in the group, you can send them straight to me if you want, but it's really cool stuff, and I think it's an important exercise that you guys kind of go through and think about like all the different tools that you have at your disposal and try to combine them in a way that makes sense to you. And that is it for tonight. Any questions? None that I can see at the moment. So I hope that you have a great evening, and we shall see you again next week.